I drive an electric car and I fuel it with the energy from the sun, from solar collectors. It doesn't cost me anything, and I'm not affected by the oil price. So if everybody did this, then we wouldn't need to have big armies to protect our oil interests in the Middle East or wherever. And we need to be more creative about ways to fix our problems, and socially responsible investing is one way to do that.
There was, for many years, on the asset manager side, this demand to map the SDGs to the funds that they were managing. And that was challenging in itself because most asset managers want to not just meet, but beat their benchmarks. And some of the SDGs didn't quite fit in well with some of the funds and the strategies of the funds. And so there was efforts to kind of achieve those SDG goals by mapping to the portfolios, but it really did show the gaps that asset managers couldn't meet. Welcome everybody to episode 6 of Inside the Flows. I'm your host Iyassu, and I'm joined by special guest Allan Moskowitz. Say hi to everybody, Allan.
Hi everybody, thanks for having me. It's a pleasure to be here.
I want to thank everybody for joining us, and hopefully you're hearing us in your car ride home as you go pick up the kids or end the day at work. And hopefully you learn a little bit about what's going on in the sustainable investing world, what's going on in the markets, and how that ties into your advisory practice or just your world in general. So thank you again, Allan, for joining us as our special guest today. Before we dive in, just a quick reminder, the discussion Allan and I are going to have is for educational purposes, and it does not constitute investment advice. So we're just here for education, no investment advice. If you need investment advice, go contact a financial advisor somewhere in your area, and they will be able to help you out appropriately. So it's Friday. We usually kick off the weekly recap with what happened starting on Monday. But because we have Allan as our special guest, I'd like Allan to introduce himself and talk a little bit about his background. So, Allan, why don't you introduce yourselves to the audience?
Well, anyway, like I said, thanks again for having me. My name's Allan Moskowitz. I'm a certified financial planner and accredited investment fiduciary, and we work in Berkeley, California, and I'm a veteran of the sustainable, responsible investment and impact investment advisory community. Been doing this for over 35 years. Of course, now they call it ESG investment, but we'll get into that. But I was doing it before they started calling it ESG investing, before we even knew what that was. But anyway, and they used to call us tree huggers, because I started out as an environmentalist. I attended the first Earth Day back in 1968. And back then I was, doing and teaching organic gardening. And, before they called that regenerative agriculture now. So these things the names are changing, but it still remains the same. There's still the same thing. So I work with individuals and small businesses and mission-based organizations like nonprofits to help them with their, aligning their investments with their values. So, and I've attended more than 25 socially responsible investment conferences, and I know many of the pioneers in the industry, and which we'll talk about later as well.
Yeah, it's great. I mean, one of the things that I try to do for my audience is to bring to light some of the really cool people that work in this space. And, by definition, you're part of that crew, Allan. There's a lot of cool people doing really cool things in the investment advisory space that don't get much sunshine. And so bringing somebody on like you, I think is very helpful for the audience to know who you are, understand where you came from and what you're doing. And also the kind of like the path that you've paved for future generations of sustainable investors. So it's really awesome to have you on. And then also, Alan and I know each other for many years now. He was one of the first, SRI, ESG advisors slash wealth managers that I got to interact with in my career, and we've kept in touch ever since. I think our first big meeting was a BASIF meeting, Alan. It was BASIF, for the audience members that don't know what BASIF is. It's the Bay Area Social Investment Fund. It was a group that was based out here in the San Francisco Bay Area with some really passionate folks. And I got to have a good conversation with Alan early on in my career. I was a pup and have kept in touch with Alan ever since. So yeah, thank you, Alan, for coming on the show.
Sure, you're welcome. Yeah, well, you can see in the back here, it's a BASIF poster
Yeah,
with
there's
the
there.
with the United Nations Sustainability Development Goals in the shape of a heart.
That's pretty cool. The SDGs. That's
Yeah,
awesome.
that which is also so. This is also a symbol of the SDGs. My pin that I wear, in my opinion. But if we could achieve the SDGs, that would fix what's wrong with capitalism.
Do you want to just let the audience know what the SDGs are? Just generally speaking, like for some of the folks that have no idea that the SDGs exist, do you want to?
Yeah, well, so the United Nations developed these goals before the millennium, before the year 2000. So they used to be called the Millennial Goals, and they were trying to achieve like all these goals like clean air, clean water, getting rid of poverty, all these aspirational kind of goals. Um, Prior to the millennium, but of course they were not reached. So now they changed the name to just the Sustainable Development Goals, or SDGs, and we're still trying to work on them. But the way we use them in the industry typically is to show how our investments impact, the kind of impact they have. So, say for instance, um, like if like you have, say, bonds that help support affordable housing, that would help, reduce poverty, things, so there are ways to show like the impact of our investments. And, and if there's something that's, like makes things more efficient, so there's less air pollution, that's, clean air, or same thing with water or whatever. So, anyway, I would suggest, you can easily find, if you just Google the SDGs or UN Sustainability Development Goals, I would encourage you to look at them. And then the final goal, the 17th goal, is to basically cooperate with, so we're one world, one planet, but we need to learn to get along with each other. So, so the final goal, which may or may not be achievable, is to actually cooperate and get along with each other, which is a good goal, because, like I said, we all share the one planet, and there is no planet B.
Yeah, that's very true. There was for many years on the asset manager side this demand to map the SDGs to the funds that they were managing, and that was challenging in itself because you as an most asset managers want to meet not just meet but beat their benchmarks, and some of the SDGs didn't quite fit in well with some of the funds and the strategies of the funds, and so there was efforts to kind of achieve those SDG goals by mapping to the portfolios, but it really did show the gaps that asset managers couldn't meet, and so the need for having government step in was very evident with the SDGs, and that's a good thing. It's we have these aspirational goals, like you said, Alan, and we're tasking all parts of the economy to help achieve those aspirational goals. And when you find a gap or something that can't be addressed by one party, then you look to another party to fix it. And so it was a really, really interesting exercise. And again, they are aspirational, but it's not just about the end goal, right? It's about the journey and trying to get people to figure out these really complicated problems about, our people and planet and whatnot, and trying to get them to achieve a higher goal. So the SDGs they're pretty cool.
Take us. I think another important tool, that they provide an important tool because people want to know, like with their money, like, if they invested, ESG and SRR, are we really doing anything? So it's one way to show people that they are, so that their money does make a difference, and that's what people want. And this is just another way to show that. So we're seeing more and more, I think, using the SDGs as an illustration of how our money impacts the world,
Yep. Yeah.
which is a
And it's
good
funny.
thing.
Yeah, it's a good thing. And it's funny, Alan, a lot of people aren't really enmeshed in the investment space. They just hand their money off to somebody else and say, hey, grow it. But when you give them the options, additional options other than just pure, total shareholder returns, and you say, hey, your money could go to, one of these SDGs, whatever, alleviating poverty, or, building affordable housing through CDFI, allocations. Yeah, a lot of people get interested. They're like, "Oh, I didn't know you could do that. There's other options." And then you get that interest, and then folks then naturally will say, "Well, what are my values? Where do I want my money to go to?" And that's a great conversation for advisors and wealth managers to have with their clients. And it also drives a lot of stickiness too in the space. You're living and breathing it, Alan, over there. All right, so that's a great intro. Moving on to our weekly recap. This was a very interesting week. There's things we can't avoid in the headline news. If you saw on Monday, Brent oil hit $80 a barrel as tensions escalated in the Middle East. Essentially, the Strait of Hormuz was blocked off because of the attacks by Israel and the US on Iran, which, what it means for the investment advisory world is that as oil prices spike, then energy costs go up. And why, most folks in the audience, especially if you're retail, say, okay, gas is going to go up because there's fighting in the Middle East. But it's not just gas. Everything, the cost of producing goods and the cost of transporting goods also goes up because of oil prices going up. So, what does that mean for your everyday life? It means things are going to get expensive, at least in the short term. So that's something that's really important to understand. As oil prices start to go up, everything goes up, and you start to see, especially in the stock market, a pullback because of those newly baked in energy costs. Wednesday, the Wall Street Journal reported that Morgan Stanley is laying off 2,500 employees, which sounds like a lot, but it's only about 3% of its workforce. And what's notable here was that Morgan Stanley had a pretty good year last year, posting record annual revenues in their wealth management division, which most folks in the investment advisory space know them for. Uh, and the rationale for the cuts is employee performance related and just shifting priorities and whatnot. But it still ties into this trend that we've been talking about on this show for the past couple of weeks, and that the white collar workforce is shrinking. So we're seeing that across not just the tech space; it's also hitting the banking and financial services space as well. So that was a big news that happened on Wednesday. And then Thursday was something that was really interesting, is on the topic of AI, is that a new product was launched called Prime Meridian, and it's an AI powered tax service. So, most folks know that the free service that the government provides is pretty much going away right now. And this new AI powered software, Prime Meridian, it might be a great replacement for it. One of the former IRS commissioners, Danny Warfield, is part of the company that's putting on this new AI powered tax software. And it's supposed to help the simple 1099 K1 filings that most folks under $100,000 use, and it's supposed to be free. So that was a really cool thing, seeing another great use case of AI stepping in and filling a gap that no for-profit company and even some nonprofits don't even want to step in. Did you see that, Alan, that there's new AI tax-powered, software that's coming out?
Yes.
Yeah,
And
the
I don't know if it's, I mean, I think it's probably a good thing. Um, I think that AI has the power to not only, I mean, it's sure it may replace some jobs, but it's also will help people do more and do better, so they can do more in their jobs. So I actually think it'll increase productivity as well. And it could also create jobs. So I'm not sure people, understand it. Of course, anything new people fear. So, it's pretty typical.
Yeah. Yeah, I think it'll be helpful. I think a lot of jobs that are being lost to AI nowadays, I'm starting to become a believer that it's not due to AI coming in and replacing them. I think a lot of companies overhired during the pandemic, and now they're trying to find any excuse other than blaming themselves for overhiring. So they're saying, "Oh, well, AI is going to come take the job," or it's no longer the weather or some other macro event. It's AI now that's reducing headcount, as the story goes. But yeah, I think AI is going to make folks a lot more productive. I think it's also going to make them more creative, Alan. I think that once you give somebody a new tool, they're going to explore it in every fashion that they can, and we're going to see some new creative uses. I have seen just the other day on BART, which is the kind of municipal train that the San Francisco Bay Area uses to get around. Yeah, there was an ad in the BART station that said basically, "Hey, we're this new company. We do AI code reviews." So they basically take whatever AI, software that you developed, and then they put a human on it and just fix all the edge cases that the AI can't get. So there's like new companies popping up because of this new transformative AI industry that's taking over. So I agree with you, Alan. I think we'll be more productive and more creative going forward.
I think it could also be time saving because it's so fast. And, so they're like, for instance, in our industry, we use uh, CRM, uh, customer relation management software. So, after a meeting, you have to type, whatever you talked about in the CRM. But with AI, it it can summarize the meeting and put it there for you. So that could be a big time saving tool as well. So instead of me having to type everything in, it does it automatically for me.
Yeah, that's something I hear left and right from a lot of the advisors and wealth managers is the admin part of your job is so time consuming. You want to bring in clients and you want to work with them, but then after they leave the office, you got to fill out a bunch of paperwork or get bank statements signed or whatever that takes a lot of your day, whereas AI can just kind of fill it in for you while you work on more important, more valuable things like relationship building and relationship management and having conversations with clients and whatnot. Like you don't have to figure out how do I add them to a calendar invite. All right. And then moving on to Friday today, the big news that came out was Department of Labor released the employment numbers, and it looks like February we were down 95,000 jobs, and that's a pretty big difference than the previous month, which was, I think we talked about this, up 125,000 jobs, and the vast majority of them were healthcare related, and I think it was like ambulatory services. So we're starting to see a picture being formed that is going to be very challenging for the Federal Reserve to combat inflation, but at the same time combat job losses and the tough environment for employment. So it's going to be interesting seeing what the new Fed chair does going forward, and how the governors of the board either vote in favor, vote against, because it's a very, very tricky environment to manage interest rates, manage inflation, and then also manage employment, given all of the macro events that are happening all at the same time right now. So those are the big news that happened this week. Very, very interesting times, and look forward to seeing what happens next. Moving on to kind of like the special topic that we have for today, which is essentially it's Allan. Allan is our special topic. He is our sustainability expert, and I asked Allan to come on the show to talk about his perspective on ESG and SRI and sustainable investing. And I really do like to highlight folks who've been in the industry and who really know, who are movers and shakers, but don't get much sunlight out there. And I'd like to treat my audience to some of the players in the space. And Allan, you've been around for quite some time. I mean, you're still young, but you've been around for a while. And this
Yeah, I don't
topic,
think I'm young anymore.
young at heart, young at
I'm not
spirit.
that young anymore.
This topic has been widely covered, yet it's regularly misunderstood. And so whenever we get to one of these kinds of situations, I always like to ask, how did we get here? And so you have a particularly interesting perspective by being in the sustainable investing space for decades. So just walk us through your journey into this space. Tell us about some of the major players you came across. How did the space grow into what it is now? And give us your overall thoughts.
Yeah, so when I first started in this industry, there wasn't anything near what there is today. It was pretty sparse, and however, being interested in the environment. Like I said, I went to the first Earth Day in 1968. I became an advisor. I think it was in the late 70s. And back at that time, in South Africa, there was apartheid, which is, like huge disparity between the civil rights of blacks and whites. And, the blacks were being, like they were being oppressed and thwarted and killed if they resisted. There were big demonstrations where people were just shot. Black people were being shot on the street. And at that time, there was a movement that started. It was basically started by the faith-based community to divest from South Africa. And excuse me, and this movement, grew from the faith-based community to other people that had, concern about human rights. People like me, and also people like, that were like my friend Lincoln Payne, who was another advisor, the late Lincoln Payne, who worked in the South alongside these people that were being shot also in the South because they were trying to get people to register to vote, poor people and black people to register to vote. And those people were, several people were shot in the South. And Lincoln actually told me he was shot at. And anyway, so and then as far as the apartheid movement, it was started basically in large part by someone named Tim Smith, who's still alive today and still involved in the industry, although he is, quote, retired. But he's still very active. I still see him, at conferences. And but he's like the granddaddy of us all. He was like the original SRI person, getting people to divest their money, like the Catholic Church and whatever the Catholic diocese, they have a lot of money, and getting them to divest from South Africa, and the word spread because you saw you know you could see the violence on television. It was being televised, people being shot in the streets. Um, so that kind of started this whole movement about human rights and also the environment, and like I said, because like Earth Day, so there was interest in all these things, and I, and back in the 70s or 80s, I was working as a chiropractic physician, but healthcare changed a lot. I got very interested in it. Was when I started, there were no HMOs. Anyway, so I started investing for myself, got very interested in it, and people started asking me for advice. So then I realized, oh, there's a need for that too. But anyway, because I was an environmentalist, I was always very interested in the socially responsible investment side of the industry. So I was doing that from the beginning. Um, and, and of course, that's grown tremendously now. And I would say it's mainstream. ESG investing is pretty mainstream these days. It's being adopted by managers that you wouldn't ordinarily think do, although now we're getting pushback from it as well. But people are still doing it, but they may not say they just aren't being as public about doing it. But the reason they're doing it is because the ESG stands for environmental, social, and governance issues. Basically, what they are, they're data. It's just data, information. But what they are is they're what's called factors. So, just like profitability or valuation or size, so environmental issues like, is there climate risk? Is there fire danger? Is there, water, is it like too much water use in an area where there's water scarcity? So is there flood danger, like with real estate? Are you building right on the coast where there might be sea level rise in, the next decade or two, whatever? So these are risk factors. So they're not just data, and they're not just preferences for people. They are actually risk factors, and they are long term. So they may not be financially material immediately, in the immediate time, but over time they can and do become more material as things happen. And as we know, crap happens. So anyway, yeah. So I'm standing on the top of these giants in the industry. There's like Amy Dominy, who started the Dominy funds. Peter Kinder, who was he was a attorney, very involved in the pushback because they were saying that to do ESG investing, somehow that's not, if it's not financially material, then it's not fiduciarily responsible. Although there is, of course, it is. Like I said, it just doesn't necessarily mean it is at the moment, but they definitely are risks, and So by looking at ESG factors, we look at all the other standard financial factors, like I said, profitability, valuation size, but we also look at environmental, social, and government risk because, I mean, there's reputational risk to companies if they don't do smart things, or if they're lying, if they have poor ethics, or if they, use sweatshops and child labor. Those are all reputational risks. They may not be financially material immediately, but they definitely can be and often do. And so they are important. And I think that people that look at those things are more forward looking. So you can't, we say in the industry, past performance is no guarantee for future performance. Well, it's the same thing. You can't look at, you can't always do things the way that they have been done because that's not the best way to do it. This is the problem, like with the oil industry. They want to keep the status quo because we're addicted to oil, and they want to keep it that way. They don't want us to, use renewable energy. That's why they're trying to stop wind, all the like these wind farms, like coastal wind farms. That's why the fossil fuel industry is fighting against that. That's why. It's because they don't want progress. They want to keep the gold, but them that's got the gold wants to keep the gold. So they're digging their heels in and preventing progress. And that's not the best way to do business. And, eventually we will see that these things are going to hit the bottom lines of fossil fuel companies. However, they have done very well in influencing the lawmakers with their money. And it's also an affordability issue because preventing progress makes things more expensive. And that's what we're seeing. And you have to pay a lot of money for like armies to protect your interests in the world, which is what we're seeing right now in Iran and in Venezuela.
I think
But I'm not
Allan,
realizes that.
you just kind of demonstrated right now, you know, this whole like value alignment theme of where, you know, clients, if you want or need an advisor, even if you didn't know, like sometimes you don't know and you figure out you do need an advisor that aligns with your values. Like this is a good example, Alan, of you demonstrating kind of like that fight that there's that advocacy fight in you about, producing positive environmental impacts and positive social impacts that maybe the general a regular, I don't want to call them regular, but like a non-sustainable, non-SRI aligned advisor
Tradition,
can't give a
a
client.
traditional, I would say a traditional advisor.
A traditional, yeah.
Yeah,
And like this was a good example of what you get with, Allan Moskowitz and other sustainability aligned uh, wealth managers out there, because at the end of the day, the client wants to know when nobody's looking, are you doing the right thing? Right. That's in their best interest. And clearly you are, Alan, like just based off what you just said, for the past couple minutes. And I think there's value in that. And I think that, it demonstrates, your commitment to your clients, but also to the values that you and your clients are very much aligned to. I think also I do want to go back to some of the people that you had mentioned earlier. So Lincoln Payne, like there are some big movers and shakers that are very well known in the sustainability space, but the general public just kind of just doesn't know, and that's kind of on us. We kind of lived in our own bubbles, and some folks, they did branch out and go, kind of public, but I'd say the vast majority of people who do a lot of great work or who have done a lot of great work it's kind of like insider ball on who they are and the accomplishments that they have. And Lincoln always, like Lincoln was a great one. I remember Lincoln. It was at a BASIF meeting, and he was telling me, I think it was like he was protesting the Vietnam War, and he was being like forcibly removed by either the campus police or the city police, and he was telling me how they just like punched him in the face to get him to move. And having somebody like that fighting for your rights and just basic like civil rights is I think there's a lost story about that those people in the SRI space, that community, because it was a lot of folks who were really believing in civil rights or environmental activism, or just people, planet, positive growth impacts. There's a story that's been lost, and these are the folks who, and then also the faith-based folks, like I can't forget them, who wanted to embed values into investing and moving capital in certain ways. I think that those stories get lost because of the insider ball. So I'm glad you're bringing them up, because these are folks who have done some, at that time, these were radical things, like to think about environmental factors in your investment strategy was like radical back then. And nowadays, it's like, oh yeah, you probably don't want to build that, supply chain warehouse system around a flood zone. It's probably not a good idea, right? Or you probably don't want to have you know your your like really expensive handbag be made in a sweatshop for like pennies on the dollar, and then sell it for like $10,000 and expect customers to be like, that's cool, right? And like those are like radical thinkings back then, but right now it's like, oh yeah, that makes total sense. So I'm glad you brought some of those movers and shakers up, because those folks are really important in driving the sustainability movement today.
Yeah, I think there's another aspect to this that people aren't thinking about either. Although more people are, so like if you build, so like people in Florida where there's hurricane dangers, which are getting worse all the time, and the damage is getting worse all the time. They can't even get insurance, or they can't afford the insurance if they can even get it at all. And the same thing's happening in places like California where there's fire danger. So they can't get fire insurance, so they can't get a mortgage, so they can't afford to live in a certain place. So and it's happening a lot more than you think. So it's now it's affecting real estate and also in the insurance industry and the finance industry. So it's having a broader effect on the economy than people realize.
Yeah, you know what's funny about that, Alan? So are you familiar with Redfin and Zillow?
Redfin, yeah.
Yeah, so like a couple of years ago, a buddy of mine was trying to convince me to buy a house in Miami, and I went on Redfin and Zillow just because you just explore what your friends asking you to do. And I was looking at, so Redfin and Zillow, they break down the cost of the house, so like what the price is, how much your mortgage is going to cost, what the monthly cost is, and I was like comparing like the total value of the homes from California and Florida, and I was like, it's the exact same. Same square footage, same uh total price. But when you look at the breakdown, it's very different. And the biggest chunk that was driving the values to be the same in Miami was the insurance. Like, because insurance costs are broken. I was shocked at how much insurance homeowners had to pay in Miami. Like,
Yeah,
shocked.
insurance rates keep going up. So yeah, so it's not getting any better. So it's making life less affordable. And that's why people, younger people can't afford to buy homes anymore. Or, it's much harder for them.
Yeah,
So
yeah. It was funny, man. I was like, okay, well, the amount I pay in property taxes in California is the exact same I would pay in homeowners insurance in Florida. Like, and everyone complains
that's a
about
lot. Yeah, that's a lot.
property taxes in
Right.
California. So, yeah, thanks for that breakdown, and yeah, the history aspect of the SRI space, and throwing some of those important names out there like Lincoln, and I'm gonna put some pictures and up so folks can see who we're talking about. But just kind of moving on to some the part of the pushback that you talked about, Alan. And you're part of them too, the USIF organization, and every now it's every year they put out a trends report, and last December, their newest report said they're seeing $6.6 trillion in sustainable assets under management, which is essentially 11% of the total US assets. And so 25, I'm going to read this, 25% of respondents have stopped using the acronym ESG entirely, and 29% are explicitly pivoting to demonstrable financial materiality. So, how should advisors and wealth managers frame the sustainable investing topic to a client today using this sort of refined risk focused vocabulary? You touched on it earlier about ESG just being factors, but how do you have that conversation with a client?
Well, I never liked the term ESG investing anyway. Yeah, it was I mean, I understand why it was, used. I think it was coined by the United Nations because, there are because most of what socially responsible investors concentrate on are environmental, social, and governance issues, which, covers a broad range of issues. Um, and people often ask me, well, when am I going to retire? Well, my kind of, patent stated answer is, well, when all investing is SRI investing. And in a way, I think that, like I said, there is more broad usage of these, the information, the data, but not everybody is calling it what they do. Saying that they do ESG investing, and that's partly for fear of reprisal, but also I think that it's confused. It's somewhat confusing, and it's not exactly what we do. It's not why we do it. It's just but I understand because these factors can be somewhat measurable, although nobody uses them in the same way, so they're not standardized. So that also causes problems. So I think, and what some people are doing, and it probably is a better way to do this, is they call it like values aligned or values driven investing. That might be a better way to do it because people they want to invest in what they care about, what's important to them. And, this way you can do that. Um, and, so what do you care about? Well, a lot of people, I mean, I'm a grandpa and a great grandpa. I have, children, grandchildren, and great grandchildren. I care about what kind of a world are we going to leave for, future generations. And, I don't want to leave them a mess. And I don't want them to say, why didn't you do something when you had your chance? So I feel responsible to, just as a person, and also from my own religious background, there's, something, we believe that, I mean, it's not our responsibility to fix everything, but it is our responsibility to try to fix things. And, and we have, we definitely have problems. And, I mean, so we, and we have all these severe weather incidents, people, you can call it climate change, you can call it whatever you want. But severe storms are getting more severe. The damage from them is getting more severe, and and they are the result of you know global warming, and we're seeing people having to move because life is getting unlivable on our planet in certain places, and it just keeps getting hotter, and like in the whole western United States is now a drought area. So so we need to adapt And, we need to do smart things, and those things are investable. And we need to, be more creative about ways to fix our problems. And, socially responsible investing is one way to do that. Was it Wayne Gretzky? They asked him, how was it he did so well? And he said, well, it's not. I'm not going to where the puck is. I'm going to where the puck. I'm trying to go to where the puck is going. So this is, my approach to investing is you invest to where the trend is going, and those are usually good bets. Although of course, you don't want to make big bets on anything because not everything is going to do as well as you think.
I love a good sports analogy.
Right.
I want to go back to the comment you made earlier where you said you don't really like the term ESG. And it got me thinking about kind of my early years in the space where there was this really big push for rebranding. And
Hmm.
I think the excuse that I heard for why you want to rebrand from SRI to ESG was Milton Friedman, the famed economist, wrote that essay in the 1970s, and it was called the social responsibility. Well, I think he said the social responsibility of a business is to maximize profits, and it was a way to uh, connect socialism with SRI investing and say SRI investing is socialism. And back then, like, socialism was a really, really, really bad thing to say. And so the industry, I think the sustainable investing industry was looking for ways to grow, and being associated too closely with socialism wasn't the right route. And so I know Kofi Annan first coined the term ESG, but like there was a push to rebrand. And I think that's why we have this like noodle soup of acronyms now,
Hmm.
right? It's
Hmm.
not just like
Hmm.
ESG, it's like
Right.
socially conscious, impact investing, yada yada yada. There's probably 10 other three letter acronyms. Um, and it's just interesting that at the end of the day, it's trying to accomplish very similar kind of goals, which is a shift away from traditional investing and adding additional solutions to traditional investing alongside, this uh, uh, alongside it. And so that's what I found really interesting with what you said earlier about I never liked or I don't like the ESG term. It's not what the origination of why the rebranding happened under my impression was that we needed to move away from socialism, and that's where it got us to where we are.
Yeah. Well, I mean, I don't know that it needs to move towards. I don't think that what you do is socialism, but um, although not that I think socialism is bad or capitalism is bad, but um, but there's definitely pros and cons to everything. But what I think that what we're trying to do is to make things more sustainable, and that's kind of why sustainability and like the SDG goals, those are sustainable goals. So I think what we're trying to do, we're trying to promote investments that are more sustainable, that are sustainable. It's like the Native Americans, they talk about 7 generations, so we need to think long term. And, like I said, creating a world that is going to be a good place for our children and grandchildren and their children. So it's about sustainability. And, what isn't sustainable is probably not very good, and we should get rid of that. So we need to return to a health, to like restoring and regenerating the health of the planet, the health of the ocean. And we need to figure out ways to do all these things. And there are ways. We have the technology and the knowledge to be able to do it. But do we have the wisdom and the political will to do it? That's the problem. Is the vested interests are using their money to influence things that it's going backwards. We want to go forward, they want to go backward, or just keep things the same. But if you want to make things more sustainable and healthier for everybody and everything, you have to change. So we are promoting healthy change in the world and positive change for positive impact. And that's really in a nutshell, what we're trying to do and why.
Yeah, that's very well said. I want to move to my favorite part of the show, Alan.
Okay.
What are you looking forward to next week?
Well, it's a good question. uh, uh, I mean, I like doing what I'm doing. So I'm like I said, I'm not young. I'm in my mid 70s, and I mean, I would like to spend as much time as I can with my family, but I can't, practically do that because they live too far away. And I'm still working, and so I mean, I do enjoy working with clients and just helping them live better lives and to get their ducks in a row, to prepare whatever documents they need so that if something bad happens, that they're not left in the lurch. And I'm a financial planner, so I like planning. 'Cause as we say, you know, fail the plan to fail. So and so it's all about. I mean, and I think that there was another person, William McDonough. He was an architect. He wrote a book. I forget the name of the book, but the book itself was like made from recycled paper or something like that. But anyway, it was like build with the end in mind. So I think you need to look at the why first. Why do we need to do this? So that if you can understand why you need to do something, then you should do it. you know so and take whatever steps you need to get there. And that's what we're trying to do here, is to build you know appropriate portfolios for people, but that will help them reach their goals. And in a I mean, of course, we have to be competitive as far as return your profitability and all that, profits. So we have to concentrate on that too. But you don't have to give up, you know, performance to have, to be able to do these things. Although there are, of course, things that, some investments with higher impacts, you might have a slightly lower rate of return. But but so you can use a smaller percentage of those high impact investments in order to achieve your goals. So because it doesn't, if you have 1% in a lower performing investment in your portfolio, it's not going to affect your portfolio returns very much at all. So
Yeah, like a good example for that is microfinancing.
right,
So you could allocate a small percentage of your portfolio towards a microfinancing institution that provides loans to, small business owners in different countries. So like, Tanzania, Colombia, some countries where the vast majority of small business owners don't have access to finance, and you can still get a return on that investment, but you also have a huge impact in driving that local economy that the small business owner is getting a loan for. And you don't have to, bet the bank on them, right? You don't have to allocate your entire portfolio to them, but that
right.
small portion that you do allocate can have a huge impact on the livelihoods of those.
Country too, not just
Yeah.
overseas, but there are people in this country who need a hand up and not a handout. So that's a way to do it. I mean, like just investing some of your money and keeping it local, putting your money in a credit union instead of a big bank, as opposed to a big national Wall Street bank where all the profits go to some CEO, who's making, hundreds of billions of dollars, whereas put it in a local credit union, which is a nonprofit organization. So you don't have those kind of issues, those governance issues of, too much, you know, overly compensated CEOs.
And it's amazing what some of those like credit unions and CDFIs. Let's not forget CDFIs. What they can do. I remember going on a tour with like Boston Community Capital, and we went to this one of the restaurants that they had loaned out to, and the restaurant owner basically hired formerly incarcerated individuals straight out of jail, and gave them a job, because that's how hard it is for people who've been in jail to get straight again. Like they just, they can't. Like no one wants to hire them. So this restaurant owner was hiring them, and they were doing great. I mean, and they weren't making minimum wage either. They were making a decent living, being able to live out in, maybe not the fanciest parts of Boston, but it was a pretty inspiring story, to helping, I don't call them the lowliest, but like the folks who need the help the most, giving them a hand up, and not a hand out. All right.
I think your viewers are going to want to know what a CDFI is.
A CDFI is a community development financial institution,
Such
and
as a credit union.
yeah, and they basically, are very small organizations that work in the local communities that they service, and they typically find areas where, they're underbanked, and you don't find the banks, wanting to service those areas because there's just not enough money there for them to provide the banking services, so they ignore them, and these CDFIs come in and, replace, or try to provide the financial services that these underserved communities rarely ever get. And it's not just like, somebody in like, Chicago, Boston, like, dense cities. It can be, rural areas, as well, indigenous people's lands. These CDFIs, don't discriminate.
So you're keeping your money local instead of sending it to Wall Street. So, which is, you want to keep your money in your community where there's more local impact.
Yeah, yeah. So that was thank you for that, Alan. I tend to forget not to use acronyms and to be expository
Who
to the
doesn't?
audience.
Anyway, I mean,
SDGs, ESGs.
so like, being sustainable, I mean, who doesn't want to be to live sustainably? Who doesn't want clean air and clean water and health, being healthy, having, the ocean be healthy. I mean, everybody wants these things, but, we tend to get our priorities mixed up, and, so we often forget about the why.
Yeah, I always laugh when people say, ESG investing is not helpful, and I just go straight to the G. I'm like, so you're telling me, understanding the governance of a publicly traded company is not helpful? Like understanding the structure of how the CEO is the chair and they're their own boss, and for some reason their compensation always goes up regardless of how the stock does. Like you're telling me that's not helpful to understand? So I don't know. It's just funny sometimes when you
Yeah.
come across some of these arguments. You're like, all right. But anyways, that's it for our show today. I want to thank, Allan Moskowitz for joining me on this wonderful Friday and giving us some great insights into the SRI, ESG, sustainable investing, space. Allan, you've been great. I want to thank you for participating in this. I also want to let folks know that if you are a financial advisor, an asset manager, a planner, work for a registered investment advisor, you can keep the conversation going if you join inflows.com. It's free to join. I'll be on there. Allan, I think you're a user, Allan. You're available, and it's exclusive to just, the registered investment advisory community. So unfortunately, retail, the time that you get to, hear or see the conversation is through these podcasts. But Inflows is a exclusive, professional networking platform for registered investment advisors and affiliates, and love for you all to join. Thank you again, Allan, for joining us.
Thank you for having me. So one of the things I appreciate about this industry is all the visionary people like you.
Thank you.
Yeah, and when we go to these conferences, we get to hang out with, very intelligent, forward-looking, smart, intelligent people who also like to have a good time.
I'll probably cut that part out.
Okay, it's okay. It's all right. We like to have fun. Everybody likes to have fun. But it's also fun just seeing people and getting together and seeing what we did right and what we did wrong and how we can do better and move from there. But it's all it's not only fun and interesting, but it's regenerative for us. It helps regenerate our souls.
And with that, I'll see you next week. Thank you again, Allan, for joining us.